In the vast and ever-shifting landscape of the stock market, a select group of technology giants has emerged as undeniable leaders, driving both remarkable gains and redefining entire industries. Dubbed the Magnificent Seven, these visionary companies, Alphabet, Amazon, Apple, Meta Platforms, Microsoft, Nvidia, and Tesla, have defied broader market trends with their explosive growth over the past year. At the forefront of this surge stands Nvidia, the powerhouse behind graphics processing units, GPUs, that are becoming essential for technological leaps ranging from artificial intelligence to the emerging world of the metaverse. Nvidia has defied all expectations, achieving a jaw-dropping 215% increase in its stock price within the past year alone. This reflects a deep investor belief in the crucial role they will play in powering some of our most futuristic advancements. Hot on Nvidia's heels is Meta Platforms, formerly Facebook. Leveraging their dominance in social media and digital connections, Meta has rewarded investors with a staggering 199% return over the same period. While social platforms grapple with regulatory scrutiny and an evolving advertising landscape, Meta's influence and vast reach remain strong drivers of investor enthusiasm. Tech icon Apple, known for its seamless blend of innovative hardware and software, has achieved a commendable 25% growth rate. For a company operating within a mature market, and despite increased competition in areas like smartphones, Apple continues to deliver the products and services consumers crave. They command a fiercely loyal customer base, showcasing strong brand power even within a fickle industry. The remaining members of the Magnificent Seven, though achieving more moderate growth than their industry leaders, still leave other companies trailing behind. Companies like Alphabet, the force behind Google's search dominance and diverse technology pursuits, captured gains of 40% for its investors. E-commerce giant Amazon has transformed how we shop and spurred the cloud computing revolution. Software leviathan Microsoft continues to evolve, remaining relevant in the changing world of work and consumer needs. Tesla, the bold pioneer of electric vehicles, has become one of the world's most valuable companies despite controversy. Together, these titans have generated investor rewards within the range of 38% to 79% in the past year. The extraordinary success of the Magnificent Seven has created a striking disconnect between their market dominance and their relative size within the actual economy. Despite representing only a small fraction of companies within the vast landscape of American businesses, these titans currently account for an astonishing 35% of the total U.S. market value. This unprecedented level of concentration has experts debating whether the exuberance seen in these soaring valuations may ultimately lead to a painful, though perhaps inevitable, correction. History offers a warning. This isn't the first time investors have witnessed such a concentrated surge within a booming sector. Back in the late 1990s and the cusp of the year 2000, just 7 companies then reigned supreme, capturing 16% of the market's value. Though smaller in scale compared to today's giants, the tech-driven euphoria surrounding them fueled outsized valuations that ultimately crumbled. A painful market correction ensued, leading to years of stagnation for some previous darlings. Giants like Intel and Cisco have yet to regain their peak valuations of that era, offering a cautionary tale about the risks of relying solely on market sentiment. While today's environment differs from the tech bubble of the past, there are worrying parallels. Inflation, surging interest rates, and geopolitical instability make many high-growth tech companies appear increasingly overvalued. Investors betting on continued sky-high growth without regard for underlying real-world business performance may find themselves vulnerable if the economic environment changes more drastically or consumer demand wanes. Even within the technology spectrum, there are stark realities for some of these magnificent companies. For instance, Tesla's current market capitalization implies extraordinary expectations that their vehicle production and sales will surpass even some of the largest traditional automakers. Analysts debate whether this phenomenal ramp-up can truly materialize within the time frame of the market optimism. The Magnificent Seven are undeniably a testament to American ingenuity and technological prowess. Each has disrupted entire industries, redefined how we work and connect, and they continue to offer transformative products and services with vast growth potential. It's this vision, coupled with strong brands and devoted consumer bases, that fuels excitement and the willingness to justify lofty valuations. However, investors must keep in mind that market history tends to favor a return to more balanced dynamics based on core economic realities. We need only look at Tesla as a poignant example. Few can deny the disruptive impact and bold vision driving their success. Yet Tesla's current share price hinges on the assumption that they will achieve unprecedented sales of around 10 million vehicles annually within the next 3 years, a feat no single automaker has yet accomplished. If they fall short of these targets, their valuation stands on far shakier ground, highlighting the precarious balance between potential and what can realistically be achieved in a specific time frame. 2024 presents a uniquely unpredictable economic environment. With the November elections drawing closer, the Federal Reserve faces difficult choices in navigating inflation, interest rates. The latest report showed an inflation rate greater than expected with 3.1% in January, which automatically pushed the lowering of the rates on May or even later this year. And in this context, their ability to engineer a soft landing without further stoking market volatility becomes more harder, while the investors wait for Fed's moves like never before. The question lingers. Will 2024 bring rate cuts, further increases, or perhaps a stalemate? Each of these scenarios presents different levels of risk, especially for high-growth stocks dependent on investors' optimistic projections of the future. Until those questions are answered, uncertainty breeds an unsettling sense that current valuations are not yet reflective of the actual business environment. It's clear we are in uncharted territory with the Magnificent Seven's market dominance. Investor enthusiasm has for now outpaced traditional metrics for justifying lofty share prices. Yet markets are historically cyclical, tending to shift away from extremes, whether driven by internal pressures or external events. While these innovative companies will continue playing a prominent role, a reckoning could be on the horizon as valuations grapple with a changing economic reality. This year alone holds substantial potential for volatility, making thorough research and understanding these companies' true positions critical for informed investment decisions.